You can show up with yuan, get your gold, and you can take it home. You can take gold, Chinese gold, out of those places. China's capital account is two-way through gold on a limited basis. And so that is why I say that gold is replacing the treasury bond as the reserve asset. That's how China's doing it. And people say there's not enough gold. Well, of course there's not enough gold at current prices. This leads to higher gold prices. People say, well, the yuan's going to collapse. It did. Well, everyone's been waiting for the yuan to collapse against the dollar. Take a look at the price of gold in Chinese yuan over the last 5 years. It's down like 80%. And that's fine, because guess what the Chinese did first? In 2002, they said to their people, buy as much gold, but buy gold. Buy gold. They've been very, very clear for 25 years. The Chinese people should buy gold. Chinese banks should buy gold. So when the price of gold goes up in value,
gold and silver may be entering a historic new phase as the global financial system faces rising debt, persistent fiscal deficits, and growing pressure on traditional reserve assets. Luke Gromen, a respected macroeconomic analyst and founder, argues that the current move in precious metals could be part of a much larger monetary shift. As governments continue running enormous deficits and countries diversify away from US Treasury assets, gold could become increasingly important in the global financial system. Gromen believes this could push gold far beyond previous record highs, with long-term targets potentially reaching $20,000 per ounce. The key question is whether gold is simply experiencing another bull market or whether we are witnessing the beginning of a major repricing of the monetary system. Please take a moment to like this video, subscribe to the channel, and turn on post notifications for more content like this.
Yeah, there's a lot of people that will say, oh, the Chinese yuan is never going to replace the dollar, because you have to have an open capital account. And I always say, exactly. There's zero chance the yuan is going to replace the dollar, as the dollar's been structured since 1971, where the treasury bond and from a bigger picture standpoint, U.S. financial assets replaced gold, right? You end up with dollars by virtue of doing trade with the United States. What do you buy? You buy treasury bonds, you buy mortgage-backed securities, you buy equities, whatever. That system, China doesn't want that. They want gold floating in all currencies. That is how they're internationalizing the renminbi, which is to say, hey, Russia, hey, Iran, hey, Saudi, probably, let us buy oil in our own currency. And this is another point that a lot of people miss about what I say specifically, but more broadly, is why is China saying this? It's not because China hates America. It's not because China is trying to tip over the United States. The reality is that if China does not get the ability to buy oil, gas, and commodities in the Chinese yuan, they will have a financial crisis as they run out of dollar reserves with which to import commodities. And then they will go through a late 90s Southeast Asia currency and financial crisis. And that's a political red line for Beijing. And so the problem is if you want to pay in yuan, you either have to open your capital account fully. There's zero chance they're going to do that. They don't want to do that. They would have too much flood out, et cetera, et cetera. So you need to keep the capital account closed. Well, how do you keep the capital account closed, but also get people to take Chinese yuan, which is not accepted for all that much, at least 10 years ago? Well, you tell them, number one, you can buy goods from us in Chinese yuan. And, 10 years ago, 15 years ago, 20 years ago, that was, plastic squirt guns and, crap at Walmart, and that wasn't good for that much. Well, now it's good for Chinese AI. It's good for Huawei equipment. It's good for BYD cars. It's good for solar panels. It's good for a whole lot of stuff that most of the world buys anyway or would like to buy. So number one, China's factory base increases the acceptance of yuan for the imports that China can buy in yuan, the commodity imports. But then to the extent that you end up running a surplus still against the Chinese, in other words, you sell them oil and gas, whatever, they end up with yuan, and then they buy some of Chinese goods with yuan, but they end up with excess yuan. The Chinese have gone around the world and they've set up offshore clearing banks, offshore yuan clearing banks in every major gold hub in the world. So London has an offshore yuan clearing bank. Switzerland has an offshore yuan clearing bank. Dubai, Singapore, Hong Kong, of course, and then of course Shanghai. So you can show up with yuan, get your gold, and you can take it home. You can take gold, Chinese gold, out of those places. China's capital account is two-way through gold on a limited basis.
Mm-hmm.
And so that is why I say that gold is replacing the treasury bond as the reserve asset. That's how China's doing it. And people say there's not enough gold. Well, of course there's not enough gold at current prices. This leads to higher gold prices. People say, well, the yuan's going to collapse. It did. Well, everyone's been waiting for the yuan to collapse against the dollar. Take a look at the price of gold in Chinese yuan over the last 5 years. It's down like 80%. And that's fine, because guess what the Chinese did first? In 2002, they said to their people, buy as much gold, but buy gold. Buy gold. They've been very, very clear for 25 years. The Chinese people should buy gold. Chinese banks should buy gold. So when the price of gold goes up in value, when the yuan collapses by 80% against gold, that starts to look like a recapitalization of the Chinese household balance sheet and of bank balance sheets, which is exactly what it is. Gold's just collateral, right? Gold is just a 0% yielding bond of finite issuance, infinite face value. Yeah, I think it had sort of traits of a blow off top when we saw it go from up to 5,400. You're getting sort of the vertical lines and charts, which makes everyone in our business nervous and take some profits. And so I think it's been a healthy pullback. It's been interesting to see what has happened since it has fallen back in terms of Chinese buying and central bank buying more broadly. Central banks, with the exception of March and maybe into April a bit with the war, they've stepped right back up, which makes perfect sense, right? Because globally, if you're watching what the big Western nations are doing in terms of the defense stimmy, which is borrow money and reinvest in defense industrial base and equipment, that is both a lot more bond supply, bearish for bonds, higher yields, and inflationary, bearish for bonds, higher yields. And so what do you want to own? You want to own gold. And they've continued to buy gold. And I don't think the West, and in particular the US, necessarily is opposed to that. I think they want that on some level. But then when you see what China has done, which is, I sat on a sales trading desk for 15 years, and I've seen this before, right? So gold goes from 5,400 down to 5,000, and or down to 4,800, and China buys 80 tons, which was the most in X years. And then the next month it goes down to 4,400, and China buys 2X, the most in 2X years. And then the next month it goes down, and China buys 3X, the most in 3X years. And last month they bought 173 tons imported, and which is the most in like 12 years. And so I think they're kind of telling you what the story is, which is we will, and it's interesting when you look at that 173 tons of Chinese imports last month. That's, if I recall my math correctly, it was about $23 billion at current valuations. That $23 billion of gold imports by China compared to a $105 billion trade surplus by the Chinese that month. So they're putting almost a quarter of their trade surplus into gold on a de facto basis. And so when I say, what do I think gold's going to do? I think gold's going to continue going higher over time. I think it's going to go way higher than the 5,400 record, because what we're watching in real time are China's surpluses being settled in gold. Mm-hmm. And ultimately people say, well, there's not enough gold. Well, no, not at 4,000, but at 10,000, at 15,000. And it's also, I think, part of a solution to the problem that so many policymakers and economists are highlighting, which is, well, the Chinese are exporting way more than they're importing, and we need them to import more. Well, great. In June, they imported $23 billion of gold, and they exported $105 billion net worth of stuff. If gold was at 16,000 instead of 4,000, in other words, up 4x, China would have imported $100 billion worth of gold, and they would have exported $100 billion net worth of stuff. And China's balance of trade is flat. Now, why is this not an acceptable solution? Simple. If gold's at 16,000, guess where the dollar is? I don't know where it is, but it's a lot lower. Now, that's where we need it to be. Inflation is going to be a lot higher. That's where we need it to be to reshore. But there is an element of the West that doesn't want to see that. because that's a very big political move. That has geopolitical implications.
The global financial system may be quietly changing as more countries build new ways to trade and settle payments using physical gold. Gold trading and clearing hubs such as London, Dubai, Switzerland, and Singapore could play an increasingly important role in this process. Instead of keeping large amounts of foreign currency or government bonds, countries with major trade surpluses could increasingly convert some of those reserves into physical gold. This would make gold a neutral asset that can be held outside the control of any single country or financial system. If this trend continues, the demand for physical gold could push prices significantly higher over time. A higher gold price would also change the value of currencies and other financial assets, while increasing the purchasing power of people and institutions that already hold physical gold. In this view, the world could gradually move toward a financial system where hard assets play a much bigger role in international trade and reserves. Now, let's get back to the interview.
If we say, hey, this is just an emerging market debt problem with US and UK and German and Japanese characteristics, look, for several years, if extremes inform the means, for several years, the number one percentage performing equity index in the world was Venezuela, as the currency was just getting destroyed. And in that same way, again, I don't think the U.S. or any of those Western nations are going to hyperinflate. That's not my point. But my point is that equities rising the way they are and being so resilient are in some manner telling us what is happening, which is it's the currency. It's not, that's driving it. And we can see that a couple different ways. Number one, if you look at a chart of the S&P 500 over, say, the TLT, long bond US ETF, it is exponential. There's just money going out of bonds into stocks. And we can see that both on a price basis, we can see that on a flow basis. The other way you can look at it is equities are if you price them in gold, which is, when in the Great Depression, when the Dow fell 85, 90% from 29 to 33, US was on a gold standard. That was the Dow falling in gold terms. That wasn't the Dow falling in dollar terms. And in that same light, equities priced in gold are still down 40% since January 2000 dot-com highs. Equities priced in gold are down 8% since the fourth quarter of 18. And this is the S&P total return. So this includes dividends. S&P is down 8% in gold terms since 4Q18. S&P is down S&P total returns down 21% since January 22 when the Fed started hiking rates, even with this recent gold sell-off year to date and the rally in S&P since April. So I think the equity markets on a structural secular basis, away from sort of the very tactical near term that we described, are acting perfectly rationally, which is if you see the debt situation the way it is, and you know that the Fed has proven 5 times in 6 years that their number one mandate is not price stability, it is Treasury market functioning, and you see the U.S. government doing things that are only going to increase that debt and deficit, like this war in Iran, then it's pretty simple. Don't own long-term bonds and own equities instead. And, when you have these momentary risk-offs, then you buy all the dips. And so I think they've been conditioned to do this. They being investors and equity markets as a result have been conditioned to do this. And I don't see any reason why that's going to change, because ultimately this is another variant perception. The equity market backs the Treasury market because they've allowed this to go too long. When you look at it on through the consumption link and through the U.S. federal receipt link of non-withheld stock-based comp, if equities go down 20% and stay down, the deficit will blow out. We saw this in 2022, 2023, and you will go into a debt spiral. And so paradoxically, the stock market backs the Treasury market, and the Treasury market backs the stock market, which has sort of always been true. So they're very much in a position of what chess players call Zugzwang, which is you have to make a move, but every move you make is going to make your present position worse. So I think equity markets are being rational in dollar terms, and I think they're being rational in gold terms. You can kind of back into that, right? If you go back to when the US went off the gold standard, and you can see that debt's risen 8% and gold's risen 9% CAGR, something like that, right? So over the long run, gold is basically like a positive 1%, 1 to 2% real rate instrument going back hundreds of years. And so if I think about it that way, I would say your risk-free rate probably drops to 1 to 2%. Based on that number, which is a very attractive to very indebted governments. It's very good for equity prices. It's very good for businesses. That to me is it's another variant perception, right? Which is, oh, if we go back to gold and gold's going to 20,000, there's going to be zombies in the street. Well, I was told there would be zombies in the street when gold went to 5,000. Gold will never go to 5,000. There'll be zombies in the street. I look around. I don't see any friggin' zombies. You take it to 10. Spoiler alert, there aren't going to be any zombies. You take gold to 20,000, there aren't going to be any zombies. Now, will the real value of bonds get crushed? Yeah, but that has to happen. That's in the cake. Bonds are going to get crushed by either devaluation or war.
Luke Gromen's main point is that the recent pullback in gold does not necessarily mean the long-term bull market is over. Gromen also believes China's growing gold purchases are particularly important because China runs enormous trade surpluses. Instead of allowing all of those excess dollars or other foreign currencies to remain invested in traditional financial assets, China can increasingly convert them into physical gold. He argues that if gold prices rise significantly, perhaps toward $10,000 or even $20,000 per ounce, the value of those gold purchases could become large enough to help rebalance China's massive trade surplus. He also explains that China is not necessarily trying to completely replace the US dollar with the yuan. China wants to internationalize its currency without fully opening its capital account, because doing so could allow large amounts of money to flow out of the country. Instead, China has created offshore yuan clearing systems in major financial and gold centers, allowing countries that receive yuan from trade to potentially convert some of that currency into physical gold. Gromen sees this as an important part of China's strategy for making the yuan more useful in global trade while protecting its domestic financial system. Thank you for watching, and see you in the next video.